Have you ever looked at someone driving a brand new luxury SUV, living in a beautiful neighborhood, taking incredible vacations, and thought they've got it made? Now, have you ever looked at someone working two jobs, driving a 15-year-old car, wondering how they're going to pay next month's rent, and thought they're drowning? What if I told you both families could be living under almost exactly the same amount of financial pressure? Think about that for a second. Today, I want to introduce you to 5 American families. None of them are real, but every one of them is built from real economic data, real debt trends, and real financial pressures that millions of Americans face every single day. By the end of this episode, I think you'll see yourself in one of these families, and you may realize the debt trap isn't where you thought it was. Because here's the thing, debt doesn't disappear as income rises. It simply changes costumes. Today, we're going to climb what I call the American debt ladder. We'll meet 5 households at 5 different income levels. We'll look at how their lives change, how their debt changes, and why earning more money doesn't automatically mean building more wealth. Then, near the end, I'm going to show you one number that matters even more than your paycheck. It's a number almost nobody talks about, but it may tell you more about your financial future than your income ever will. So let's start at the bottom of the ladder. Meet Mike and Ashley. They're both in their early 30s. Mike works in a warehouse. Ashley works part-time while taking care of their 2 kids. Together, they bring home about $38,000 a year. Now, before we go any further, I want you to notice something. There isn't anything extravagant about their life. No luxury vacations, no expensive cars, no designer clothes. They're simply trying to make it through the month. But every month, something happens. The transmission needs work. One of the kids gets sick. The electric bill comes in higher than expected. The refrigerator breaks, so what do? They reach for the credit card. And again, not because they're irresponsible, because they don't have another option. According to the Federal Reserve's survey of household economics and decision-making, lower-income households are much more likely to report difficulty covering an unexpected emergency expense and are also more likely to rely on credit when faced with unexpected bills. Think about that. They're not borrowing to buy things they want. They're borrowing to survive. Now, here's what most people say. They just need to make more money. Fair enough. So, let's move up the ladder. Jason and Nicole earn about $72,000 a year. They're doing better, a lot better. They bought their first home a few years ago. Both cars are reliable. Life feels like it's finally coming together. But look a little closer. There's still student loan debt. One vehicle is financed. The family vacation? Buy now, pay later? None of those decisions seemed unreasonable at the time. Each monthly payment looked manageable. $29 here, $89 there, a couple hundred over here. But here's where it gets interesting. Nobody wakes up one morning with 10 different monthly payments. They happen one decision at a time. According to recent Federal Reserve research, the use of buy now, pay later has expanded rapidly in recent years, particularly among younger households and those facing tighter cash flow. The payments are small until you add them together. Jason and Nicole aren't surviving anymore. They're maintaining different debt, different income, but many of the same feelings. They still wonder where the money went. Now, let me ask you something. Have you noticed what's changing? It's not just the amount of money, it's the type of debt. Mike and Ashley borrow because life happens. Jason and Nicole borrow because credit has become part of everyday life. Neither family thinks they're making terrible decisions. In fact, most of the decisions make perfect sense, all by themselves. But financial pressure rarely comes from one big decision. It comes from dozens of small ones. We're only halfway up the ladder. Because next, we're going to meet the family almost everyone assumes has made it. The family earning well into 6 figures. The question is, did they actually escape the debt trap, or did the debt simply get bigger? Let's climb a little higher. Meet David and Jennifer. Combined household income, about $125,000 a year. By almost every traditional measure, they've made it. They own a beautiful home. Their kids are healthy. Both have stable careers. But let's look inside the budget. The mortgage is nearly $3,000 a month. 2 vehicle payments, student loans that still haven't completely disappeared, childcare, health insurance, homeowners insurance, utilities, groceries, before either of them buys a cup of coffee. Sound familiar? This is where so many Americans find themselves. Not poor, not wealthy, just committed. Every raise helped improve their lifestyle, but every improvement brought another obligation. A larger house, a safer vehicle, better schools. Individually, none of those decisions seem unreasonable. In fact, they're exactly what most parents want to provide. But collectively, those decisions create something powerful. Lifestyle inflation, you make more, so you spend more, then you need to keep making more just to stay where you are. David and Jennifer aren't worried about making rent. They're worried about protecting everything they've built. It's a different kind of stress, but stress all the same. Now let's move higher. Meet Ryan and Melissa. Combined household income, about $235,000 a year. This is where many people watching probably think, okay, now they've escaped, have they? Ryan is an executive. Melissa owns a successful business. The house is larger. The vehicles are nicer. The vacations are incredible. The kids attend private school. From the outside, they've achieved the American dream. But behind the scenes, there's a different story. A large mortgage, a home equity line of credit for the kitchen remodel, luxury SUV payments, private school tuition, country club dues, investment accounts, higher property taxes, bigger expectations. They earn more money than they ever imagined, but their financial life has become incredibly expensive to maintain. And suddenly, they realize something. Their lifestyle requires a very large income every single month. Finally, meet Michael. Michael owns several businesses. His income changes every year. Some years, it's $600,000. Some years, it's significantly more. People assume Michael never worries about money, but that's because they only see his income. They don't see his balance sheet, commercial real estate loans, business lines of credit, investment property mortgages, equipment financing, payroll, taxes, insurance, cash flow management. Michael isn't living paycheck to paycheck. He's managing millions of dollars moving in and out of multiple businesses. His challenge isn't survival. His challenge is leverage. Used wisely, leverage builds wealth. Used carelessly, it destroys it. Every level of income introduces a different financial test. For Michael, the pressure isn't whether he'll make the next credit card payment. The pressure is making sure dozens of people who depend on his businesses continue receiving theirs. So let me ask you something. Which family is trapped? Mike and Ashley, Jason and Nicole, David and Jennifer, Ryan and Melissa, or Michael? The answer could be every single one of them. Because debt doesn't care how much money you make. It only cares whether your obligations grow faster than your freedom. And that brings us to the biggest misconception in personal finance. Most people believe income creates wealth. That's not actually true. In our final segment, I'm going to show you the one number that matters more than your paycheck. The number that separates financial stress from financial freedom, regardless of how much you earn. Let's go back to our 5 families. 5 completely different lives. 5 completely different incomes. Now here's the question, which one is wealthy? Most people answer that question by looking at income. I don't. I look at something completely different, margin. Let me show you what I mean. Mike and Ashley. They make $38,000. After paying for housing, food, transportation, insurance, childcare, and minimum debt payments, they may only have a few $1,000s of flexibility left each year. Jason and Nicole, they're earning around $72,000, but now they've added a mortgage, car payments, student loans, and financing for several purchases. Their income doubled, but their obligations doubled too. David and Jennifer, $125,000, great careers, beautiful home, wonderful kids, but nearly every dollar already has a destination before it even reaches the checking account. Ryan and Melissa, over $200,000. From the outside, they look financially free. Inside the budget, they're managing one payment after another. And then Michael, the business owner. People assume that because his income is the highest, his stress must be the lowest. But leverage cuts both ways. His responsibilities have grown just as fast as his opportunities. Now, look at all 5 families, different incomes, different houses, different cars, different lifestyles, but they're all asking the same question. Do we have enough left over? That's margin. Margin is the space between what comes in and what must go out. And here's what I've learned after decades of helping people build wealth. Income creates opportunity. Margin creates freedom. And freedom is what most people are really chasing. Now, before you misunderstand me, I'm not saying debt is always bad. Businesses use debt. Real estate investors use debt. Entrepreneurs use debt. Debt is simply a tool. The question isn't, do you have debt? The better question is, who's in control? Are you using debt to build assets? Or is debt controlling your financial future? That's a very different conversation. Now, before we wrap up, here are a few things I'll be watching this week. Inflation data, because inflation influences interest rates, and interest rates influence almost every loan Americans carry. Federal Reserve comments. Not because every speech changes policy, but because markets listen carefully for clues about where borrowing costs may be headed. Consumer confidence. When confidence falls, families often delay large purchases. When confidence rises, borrowing tends to increase. Mortgage application data, auto loan trends, credit card delinquency reports. None of these reports tell the whole story by themselves, but together, they help us understand where the American consumer is headed. And right now, that story isn't just about income. It's about how much financial pressure households are carrying. You know, I started today's episode by introducing you to 5 different families. Maybe one of them reminded you of yourself. Maybe one reminded you of your parents. Maybe one reminded you of your children. But here's what I hope you take away. Success isn't measured by the size of your house, or the logo on your car, or the number on your paycheck. Real financial freedom is waking up in the morning knowing your money works for you instead of you working for your payments. The American dream isn't dead, but somewhere along the way, many of us stopped chasing freedom and started chasing bigger monthly payments. The good news? That can change. Because wealth isn't built overnight, it's built intentionally, and the goal isn't simply to earn more. The goal is to keep more of what you earn. So you have the freedom to choose the life you really want. What's your take on all of this? I'd genuinely be interested to hear your perspective, so down in the comments, let me know what your thoughts are. And if you found this episode helpful, make sure you like this video and also subscribe to this channel. Every single week, we break down current economic events, market trends, and historical patterns to help you make more informed financial decisions during uncertain times. Thanks again for joining me on this episode of Straight Talk. And with that being said, I'll see you next week.